G'day everyone and welcome back to this Hidden Gems webinar. Today we are going to discuss financial advice, gold and nickel, iron ore and e-commerce. Just ask some questions. If you want to ask a question, type them in the box provided. I know the CEOs really appreciate your line of questioning. Let's make a start. Nothing from me today. Markets are far too volatile ahead of this long weekend. Let's listen to some interesting company presentations. First up, we have WT Financial, ASX code WTL, market cap of around $26 million, 1 year return of up 36%. We have with us Keith Cullen, who's the founder and managing director. Now, the company is a diversified financial services company that contains two distinctive channels: their primary business-to-business operations under the Wealth Today brand, and then the complementary direct-to-consumer operations under Spring Financial. Keith, welcome back. Over to you.
Yeah, thanks so much, Tim. Really appreciate the opportunity, and thanks everyone for joining us. So today I'm going to give everyone an overview of the company and our place in the market within the industry, and also, most importantly, talk about what the future of advice looks like in Australia, something that we think is a very bright looking future. So Tim, if you could flick through the first couple of slides for me, the disclaimer there. Onto this first screen. I'll start with an introduction of the company. Well, look, we founded the company in 2010. We listed on the ASX in 2015. And when we first founded the company, our complete focus was on building a direct-to-consumer financial advice operation with all salaried advisors. And we did this very successfully, opening offices all over the country. We were profitable from our first full year of operation. As I say, we listed in 2015, initially under the Spring Financial Group name. So our ticker was SFL for Spring Financial Group Limited. We had a very strong dividend history, paying out some $7 million in dividends. And then, look, in the wake of the Royal Commission, we saw a lot of structural change in the industry, and it caused us to have a real rethink, because the impact of that structural change not only presented problems for our own operations, and that was trying to build a large branded operation of salaried advisors, but it also presented massive opportunity as we saw the disintegration of what had grown to be really a vertically integrated model, with the banks and the insurance companies really buying up all of what were previously privately owned dealer groups or AFSL holders with authorised representatives operating under them, to turn them into, in effect, sales channels. And this whole model sort of disintegrated in the wake of the Royal Commission. And we thought, look, there's a big opportunity here for us to take all of the intellectual property that we've built in having a very successful, large direct-to-consumer business, and apply that intellectual property across what was, a very large group of independent financial advisors or privately owned financial advisors that really were left homeless, a lot of them, with the banks exiting the space. And so we bit the bullet, and we sold off a bunch of our B2C assets, and it scaled back our B2C operations, and really launched ourselves headlong into wanting to build a very large dealer group model with independently owned financial advisors operating underneath licensees. And we did this through acquisition of a small dealer group called Wealth Today. We completed that acquisition in 2018. And when we completed that acquisition, Wealth Today had just some 42 advisors within its group. We followed that up through the acquisition of Sentry Group last year, and more recently Synchron Group. And this has seen us emerge now with some 600 advisors operating across more than 400 practices. So we've seen very significant revenue increases. We've been able to go through a period where we weren't profitable as we transitioned out of the B2C space into the B2B space, to come back to profitability with a good result for the first half of this year, and what we expect to be about the same sort of run rate for the second half. So a good profit for the full financial year, but really now with the acquisition of Synchron being completed in March, head into a very strong position for next year. So what does a dealer group do? Well, aside from providing the licensing for advisors that enables them to practice and deal with their clients, is we provide a full compliance and risk management framework for them. We support them with their ongoing education and training, technical support in the advice that they're giving, and we assist them with their practice management and their business development. So if you flick through to the next slide, Tim. Thank you very much. You know, we're on a mission to build the largest financial advice group in the country, and you know, with 600 advisors, we've got some $16 billion or more of funds under advice. We've got a very large in-force annual insurance premium book of 360 million. I believe that makes us certainly the largest in the country there as far as an advisory network goes. And we write new insurance premium across the group of some 25 million a year. So for 2023, we're looking at around 170 million in gross revenue, and some $18 million of gross profit. So where we've positioned ourselves now is we have emerged as the largest non-institutionally owned or non-product producing financial advisor network in Australia, and headed only by the institutional operators of AMP and Insignia, who were formerly known as IOOF. Tim, if you flick through to the next one for me. So looking at our guidance then for 2023, those numbers there that I said, 170 million of gross revenue is what we're expecting, with a GP of about 18 million, EBITDA in excess of 7, and a net profit before tax of 5. We'll have a statutory tax calculation for next year that will probably see us report 4 million, and these numbers are without growth, which we are expecting through either further acquisition opportunities or natural organic growth. Whilst we'll have a statutory tax calculation to do, as the company's got good, it's in a unique position actually of having good carry forward tax losses to use, but also a very healthy franking credit account. So whilst we'll have a statutory tax calculation, as we won't be paying any tax for some time, yet we will be able to distribute fully franked dividends once we get back to a dividend position. So next slide for me, please, Tim. Just looking at the shape of that, what I mentioned, the unraveling of the institutionalized advice networks, the big six previously had 8,500 advisors between them. That's down to being concentrated in the hands of just Insignia and AMP now, and has since 2018 has reduced by 61%, whereas the top 10 non-institutionals are up by 62%. You know, they were sitting at around 2,000 in 2018, up to well over 3,000 now, with ourselves being at the top of that table at 610, followed by Diverger, Centrepoint Alliance, and Sequoia, and then Count Plus is the other listed entity down there at number 7, and you've got a number of privately owned operations there in Capstone, Lifespan, Fortnum in focus as well. So we're well on our way on our journey of wanting to build the largest network in the country. Just those two institutionalized networks above us. So next one for me, please, Tim. So why would one be investing in financial advice? Well, you know, look, we've seen a lot of advisors exit the industry. We've seen the banks exit the industry. We've seen the cost of advice to consumers go up, and we've seen an increase in the number of consumers moving out of the advised environment. So why would you invest in the space? Well, the interesting dynamic in all of this is demand continues to grow at a very significant rate. We're right on the doorstep of the largest intergenerational wealth transfer in history, with $3.5 trillion set to pass from one generation to the next. And the nature and the type of advice people are seeking and the demand for it continues to grow. So if you flick through to the next one for me, please, Tim. You know, it's reported that there's some 12.6 million Australians with unmet advice needs, and research shows about 3 million seeking advice in the next 12 months. So whilst there's less advisors and costs have gone up, the advice practices that remain are getting more profitable. We've got a shrinking number of advisors charging higher and higher fees to a smaller number of clients. And so it's a really interesting dynamic for the industry. And we've got a government that the previous government has come out and said that they're very keen to look at ways of reducing the cost of advice. And we've got a new minister that's come out and reiterated that. So we think the future is very bright. Not only are practices getting more profitable, but we think the regulatory environment's clearing the way for advisors to return to dealing with those lower value clients as well. Really is, looking like a good future for everyone. So next slide, please, Tim. I think that wraps me up there. I'll leave that one up at the board there and I won't touch on that. And hopefully some people have got some questions that we can deal with. But just in terms of the board, we've assembled a very experienced group of operators to help guide the company. And collectively board and management owns about 32% of the company. So, really aligned interests between the people running the show and all our other shareholders. So thanks, Tim. If there's any questions, look forward to answering them.
Yeah, there's quite a few questions here, Keith. One of the questions, you mentioned a new government. Now, will they continue with the quality of advice review that's kind of in play? And do you kind of expect some relief at any stage?
Yeah, look, it's a good question, Tim. Ourselves, along with 7 of our industry colleagues, put a joint submission to the Quality of Advice Review, and those submission dates closed off 2 days after the new minister was sworn in. So it was an initiative of the previous government, not due to report back until the end of the year. And look, really the Quality of Advice Review was all about cutting red tape to try and get advisors back to being able to service the lower value clients who have been left behind. I'm really encouraged to see that Stephen Jones, our new minister, came out, immediately hit the ground running and said, the first thing to say is he'd been the shadow minister for financial services, so he was well across the sector. And he hit the ground running saying, I think you could read between the lines and say, we're not waiting till December to cut all this red tape. We're going to act more quickly. And he basically said within the next 3 months, there's a whole bunch of changes that he wants to make to try and bring down the cost of advice. So that's really exciting for us. And I think the industry knows where it needs to go, and so does our new minister.
And Keith, there's been kind of lots of consolidation happening in the industry. You've been, as a listed company, very active in regards to 2 large acquisitions in the last 12 months, which you spoke about. Yeah. You're going to pause for now, and how do you see the industry playing out in regards to consolidation?
Look, I think from our own perspective, it's not like we're rushing to acquire dealer groups at any cost, but it's certainly part of our strategy. So we've got no immediate plans. The last acquisition we did was the largest privately owned network in the country and had been for some time. So we've gone sort of right to the top of the tree there. But there's definitely other opportunities about, and we think there will be further consolidation. I think one of the key things is there's a lot of pressure on the much smaller networks to be able to deliver propositions to their advisors that meet the complexity of what's required from them today. It's a very complex landscape from an education and from a legislative perspective, and the smaller operators are really being marginalised. I'm not sure that they necessarily present acquisition opportunities for us, but I think what you'll see is perhaps some of those smaller ones exiting the game altogether, which presents good opportunity for organic growth.
And you mentioned dividends, and I think you were referring to around $4 million or $5 million profit after tax. Do you anticipate you'll be paying a dividend in the next year?
Well, look, we've maintained our dividend policy, which is as and when cash is available for distribution and profitability is there for distribution, is that we'll pay dividends at least once a year. With board and management owning sort of 30+% of the company, nearly 40% of the company, if you take in all of the staff in the business, there's certainly alignment with shareholder interests. So as soon as we're able to, yes, we want to return to being a dividend paying stock.
And it's been a tough industry to be in regards to kind of advisors leaving the industry. You've had the AMP debacle. You've got the cost of advice rising. Can you improve the margin of the advisor, and why should people be bullish about this industry?
Yeah, look, I think some of the things I touched on there before, Tim, is any advisors that aren't running really profitable practices today just haven't modernised their thinking. You know, it's a big part of having a strong dealer group like ours has been able to have the experience within the personnel of the business to work with. You know, the key thing about us is we know how to run practices. Advisors tell us when they come to us from other dealer groups that a lot of these dealer groups have either forgotten what it's like to build a practice and sit in a room with clients, or they've never known it. And it's a key differentiator within our business is that we're very focused on everything we do being from the perspective of being inside the practice with the advisor and in the meeting room with the advisor with their clients. And our view is that any advisors that aren't running highly profitable practices at the moment just need to modernise their thinking, and we can help them with that because the demand grows, and we're seeing our good advisors deal with less people for more money and more profit. That doesn't solve the social problem that the government's got of you know, Australians being left behind who can't afford advice. And that's what we hope this quality of advice review will do, which just provides a further leg up for all of us in the industry. So we're very bullish.
And by having scale in terms of number of advisors, can you offer, you know, beneficial synergies across the group in regards to technology and documentation and all those added services?
Yeah, incredibly so. Even though we're running the 3 brands still, Tim, in Wealth Today and Synchron and Sentry, what we do is everything on the back end that supports the advisors and their practices is that's all consistent across a brand, an internal brand that we've got called Wealth Advisor. So we get a heck of a lot of synergy out of all of the education and training we do, the documentation, our risk management framework. We've got the same people at back of office working right across the cohort with the advisors. And when you've got scale like we've got, the key thing is that the real intellectual property in the game is quite expensive to buy in. You know, our biggest cost is our personnel. And if you want really smart people in the place, you've got to pay them. When you've got a smaller network, it's very difficult to do that. When you've got a large network and you can amortize the cost of that IP across, you know, a significant revenue stream, as you're able to provide advisors a lot better proposition.
Great, Keith. That's all we have time for. Nice to see you again. Have a good long weekend.
Yeah, appreciate it. Thanks so much. Really enjoyed it. Tough.
Thanks, Keith. Next up, we have Estrella Resources, ASX code ESR, market cap of around $26 million. We have with us Chris Daws, who's the Managing Director. The company is a diverse West Australian-based company focused on the exploration and development of a number of gold and nickel projects and, of course, increasing shareholder value. Chris, over to you. Thank you.
Tim, how are you? Thanks for having me, and thanks for the listeners listening in, and a big shout out to the Tiger stockbroking community, who I believe are also listening in. For those that don't know Estrella, we've been around since 2017, and I've been running the business for the last few years, trying to hunt down some nickel. And over the course of the journey, we've always had in the back of our mind that obviously we want to stand up on our own 2 feet, and going to transitioning into nickel production is a strategy that we are now looking at. Some of the assets that we do have in the asset pool. The picture on the front cover of the presentation is a picture of the 5A nickel pit, which we're looking to undertake a full DFS and transition the company rapidly into nickel production. I'm going to just turn the slide, please. Standard disclaimer, you can view that onto the ASX platform. We released this presentation in the last few days, so that can be accessed. Our board and management team, some will know, we've been around for a while. I've been in the nickel game for the last 20 years. Our team's been together for the last few years, working away at trying to build quite a significant nickel business. We've managed to secure Steve Warriner, who is an expert in nickel sulfide geology and exploration. He's made numerous discoveries in his time, and he's joined the company as well. And he's been a great asset of the business as we're moving forward with our nickel exploration and development activities. Next slide, please. So Estrella at a glance, we haven't really got far from my hometown of Kalgoorlie. We have the Carboid nickel sulfide project. We own 100%, 80 kilometres northeast of Kalgoorlie-Boulder, where we made a discovery in October 2020, and we've been drilling heavily out there and more aggressively since that time. We have 2 diamond rigs out there at the moment. Our discovery at T5 is certainly proving itself over the journey, and there's still a lot of work to be done there. But the real crux of this presentation will be the Spargoville nickel sulfide project, or nickel rights we acquired back in 2017 that sit to the southwest of the town of Campbell, which is obviously the central nickel producing town of Western Australia, and is well known. So we're only 20 kilometres from that central processing facility at Campbell, and we're obviously seeking to rapidly bring Estrella forward into production in the backdrop of the current environment. If we were asked whether Estrella was cheap today, I think we'd be fairly easily poised to say yes. I think we are, with the assets that the company holds and what we've been doing over the past 18 months. I think current pricing of around $26 million, the company represents value in the backdrop of the nickel market. If we just turn the slide, please. So it really is, it's economics 101, it's supply and demand. We've seen a 65% increase in the nickel price in the past 6 months. There's been a severe squeeze on the LME, which has heightened, obviously, nickel prices, or we've seen historic high nickel prices. Stockpiles are remaining very, very low, and there's obviously a short amount of nickel sitting in LME warehouses for supply. So it's really 101 economics. Obviously, the EV and battery thematic is driving a lot of that demand, and that's only increasing as we see going out right through to in the later years. There's going to be a severe shortage of nickel, and we've placed ourselves with some great assets and looking to discover more nickel sulfide so we can supply into that demand. If we can just turn the slide, please. So with a major appreciation in the nickel price, we think it is the right time to deploy capital and to look at developing assets we bought in 2017 from WA Nickel. We haven't done a lot with the assets since we acquired it. We did drill some holes in 2018, got some spectacular results, but Carboid really took our attention because we are looking for something fairly significant out there. But the Spargoville nickel rights consist of 4 nickel deposits, the 1A, the 5A, 5B and the 5D, or the Andrews deposits, which were discovered in the 70s and developed through the nickel boom of that period. And the 5A nickel pit was actually mined in the latter part of the 1990s. We believe that these assets now, in the backdrop of the current nickel environment, would lead us to potentially get cash flow going from these assets again in light of what's actually occurring in the district. We've seen obviously processing facilities or third-party tolling facilities reopen in the backdrop of the nickel environment. We've seen a number of nickel mines reopen and be developed. So we're right in that neighbourhood, and we think that the 4 assets that we do have there, and starting with 5A, can be developed in that backdrop. So the DFS study that we're currently doing to determine how we go about mining this particular first deposit, the 5A, is really where we're focusing some attention. And it is really all about location, location, location. We were fortunate enough to pick up these assets at a time when nickel prices were much lower and they were out of favour, but you can't go too far wrong being only an hour's drive out of Kalgoorlie-Boulder and only 20 kilometres from Nickel Central at Campbell. Slide change, please. So the 5A nickel deposit is our priority. It's a small development. It's a stepping stone to bigger things for us. 5A is the least capital intensive mine that of the 4 mines that Estrella own at Campbell or Spargoville. and it's the most advanced of those projects. The mineralisation at 5A consists of oxide and transitional material, and then fresh sulfides, which we are currently drilling at the moment to determine where that transitional to fresh zone exists, so that we can then determine obviously the ore reserve and how we're going to go about in treating that material at 5A. Slide change, please. So as it stands today, that drilling has commenced for the definitive feasibility for 5A. We've got about 17 holes. In fact, we've increased that now to probably more likely 18 to 20 holes. The drilling's going very well. We've got about 3 weeks from today to complete that program. The diamond drill rig is performing exceptionally well. And so we've been obviously receiving those cores. We have been transporting the cores to our core logging facilities at Carboyd, which we've had set up for the past year and a half with our exploration works at Carboyd. So we've been logging and cutting the Spargoville cores as they've been produced, and they've been refrigerated, ready for met testing, which will get underway shortly. And the aim of that is to obviously work out the parameters of which of the material will float, how much recovery we will get, how it will perform in certain environments or certain processing facilities. And then obviously we can then target how we approach the mining and transportation and processing of that ore. We're targeted to complete this DFS over the course of the next 3 months. It's not a huge project. It's not going to consume hours and hours and hours of professionals' time, but we will have it completed fairly quickly. We've got some good personnel working on that, and we are targeting on a positive DFS production in 2023. And that might surprise a few people that Estrella is moving so quickly into production, but it's the case of the project is fairly advanced. It's fairly straightforward. It's a simple pit cutback. It's on granted mining leases. It fits within the SM small mining project class. So it's only a 10 hectare surface, or less than 10 hectare surface area. So it fits into a new category of mine development that have been streamlined by DMERS. So it's 45 days from approval once we submit our mine planning. Slide change, please. So really 5A is a stepping stone into other near-term potential assets that Estrella has in the portfolio, and they're larger assets. 5B and the Andrews deposit both have a higher capital intensity to obtain those nickel resources and produce cash flow. But certainly 5A, we believe, will generate enough cash flow for us to then step into these deposits in the backdrop of a very strong nickel price environment. And we believe that these particular assets in the portfolio will be developed by Estrella in a stepped way. We see that the assets at Spargoville in the portfolio, in the backdrop that we have, just simply need to be progressed and developed. But obviously, we first need to stand before we run. Slide change, please. So you'll see in those graphics that 5B deposit already has a significant decline development. The 5B is a shaft development down to 250 metres, and then the 1A deposit was developed on a number of levels. So quite large assets, have nickel resources with them, and we'll look to develop those. Of particular note with these assets, that they do not have onerous royalties attached to them from prior sales and purchases, and thus the hurdle to positive cash flow is much lower than some of the surrounding mines and deposits. Next slide, please. So that's us in a nutshell at Spargoville. We're already underway with the diamond drilling and the metallurgical confirmation work. We're due to commence those pit optimisation works and have that final resource model done in the course of the next couple of months. And subject to positive DFS, we look to be commencing mining and producing cash flow for the business in the first quarter of 2023. Thanks, Tim. That's it from me. There may be some questions I'm happy to answer.
Thanks, Chris. Yeah, quite a few questions actually. So was the kind of strategic shift to bringing Spargoville rather into production about generating some cash flow?
Look, it has been. We purchased the asset because the opportunity was there. The assets were I guess they're cheap. They were unloved at the time in 2017. The strategy for us has always been to discover a major ore body at Carboid Rocks, and we continue to aggressively explore Carboid, and it remains our flagship project. We've got 2 rigs out there at the moment going 24/7. The T5 discovery is expanding. We put out a release the other day that's very positive. We're seeing that the mineralisation is strengthening at depth, and that our geological model at T5 and Carboid is intact. And I guess there's an enormous area of Carboid in the basal contact where we know the nickel mineralisation exists that is still to be tested. But in the environment that we're sitting in, with the backdrop of the nickel price environment, it would be not right for us to sit back and just not take advantage of this strength in the nickel price. So jointly bringing that development through on Spargoville is just, we have to do it. It makes perfect sense for us to do it now.
And that makes perfect sense. What are the sort of hurdles in your way before you bring Spargoville into production?
Yeah, so we don't see any showstoppers at Spargoville. They're granted mining leases. We do have to complete the necessary mine plans, so right through from the submission of the mine planning, so your environmental planning and your right through to mine closure. So those documents need to be submitted to DMIRS, but it has been streamlined over the last couple of years. So since I think there was new guidelines put out in 2020, and because we fall under the SMP, the small mining project class, we only have to submit all of those plans appropriately and in detail, and then there's a 45-day period, but DMIRS will review that, and then hopefully there's no errors in our planning, and 45 days we should have approvals, and then we should be able to commence, and subject to a positive DFS of course, and locking in some processing pathways for us. We see absolutely no showstoppers to get 5A off the ground and producing cash flow for the company.
And there's quite a few questions coming through here around Carboid and T5 and where do they sit now in terms of where do they sit now in regards to Spargoville being first?
Yeah, look, we'll still aggressively explore Carboid. It is our flagship. We're doing it in conjunction, or we're developing Spargoville in conjunction, which will aid us in only aggressively exploring the rest of the asset pool. We only see 5A as a stepping stone to greater things. It'll allow, I guess, the cash flow for us to aggressively explore, but to also develop the other Spargoville assets. So we haven't lost any faith at all in Carboid. We have had drill rigs out there consistently since October 2020. We're seeing not just smoke, we're seeing fire, we're seeing massive sulfides up to 4% nickel. It's sitting within the geological models that exist worldwide. 99% of the world's nickel sits on basal contacts. We've drilled nickel on the basal contacts. So we'll continue to search for the source of the nickel copper that presents itself at Carboid, and has presented itself, looking for an economic development there. But Spargoville represents a rapid turn in the current backdrop to get the company to production and cash flow, and not come back to the market with our hands out trying to raise more capital. And obviously in the backdrop of the current environment, the market volatility certainly over the last few months has shown that potentially is a difficult environment to be. So having cash flow and having a business that can generate cash flow to develop the assets further is something that we want to pursue, and pursue it with some vigour.
Thanks, Chris. That makes perfect sense. That's all we have time for. There's a number of questions online. If you have time to answer those, it'd be appreciated. Otherwise, I'll send them to you over the weekend. Thanks for your time.
Thanks, Tim. Thanks for having me. Thanks for those listening in. Thanks very much.
Next up, we have Juno Minerals, ASX code JNO, market cap of around $18 million. We have Greg Durack, who is the managing director, with us. The company is an independent mining company which engages in the evaluation and development of iron ore properties in Australia. Greg, thanks for your time. Over to you.
Yeah, thanks, Tim, and welcome to all attendees onto my presentation today to give an overview of our Central Yilgarn Iron Project in the Yilgarn region. Next slide, if you go through to past disclaimers, Tim. Yeah, thank you. So Juno has just been listed just over a year now, and we are actually spun out the assets out of Jupiter Mines, who I previously worked for in 2007 to 2013. And I looked after these two projects directly back then. We've recently welcomed David Moroney to the board as our chairman. David has a wealth of experience in the corporate and finance space and risk management. And also Patrick Murphy, he's the managing director of AMCI, who is a major shareholder of Juno. And also Mr. Lee, who is also represents POSCO on our board as a non-executive director. So with the in-specie distribution out of Jupiter, those two major companies maintain their shareholding within Juno, and we're very appreciative of that. And of course, our company secretary and CFO is Melissa North, who we did in conjunction, did the IPO of Juno. And I share Melissa's time from Jupiter as well. So we aim to keep our overheads low in the medium term. So next slide, please, Tim. So a bit of a corporate snapshot, 136 million shares on issue. Market cap, as Tim said, around 17 million currently. Our top 10 shareholders, Nissan Bentley, who came over from a major shareholding in Jupiter, AMCI, that I've talked about, and POSCO, our major shareholders, and Tiger Hill Global Fund, who have joined us on the register after we listed, so they've accumulated shares as we've moved forward. Next slide, please, Tim. So investment highlights, we've got two projects in the Central Yilgarn. That is a Mount Mason DSO hematite project. That is now already fully approved, ready to go. And there's existing rail and port infrastructure that is available to progress this project. And we're in discussions with ARC Infrastructure and Esperance Port currently. And we also have the Mount Ida Magnetite project, which is the largest magnetite project in the region. Over 1.85 billion tonnes, 29.5% iron. It upgrades to a 67% concentrate. And it's already on a granted mining lease, and we've got significant supporting tenure in the region. Jupiter back end, we spent over $50 million on this project, so it is really well advanced in the technical front. So the value proposition, our Mount Mason DSO hematite project is a near-term project, and we're looking to get that going in the Q3, in the June quarter next year. And in respect to the magnetite projects in the Yilgarn, we are significantly undervalued in comparison to those. Next slide, please, Tim. So where are we? So in a snapshot, we're about 110 k's northwest of the town of Menzies, which is north of Kalgoorlie. And we aim to start producing a 60% DSO fines from that project. as I said, that project's been fully approved. We've got all the approvals received in early April of this year. And our Mount Ida magnetite project's about 6 kilometres away from our Mount Mason project. And that is really technically advanced. Although I have to say our main focus since been listing is on our Mount Mason, getting our Mount Mason DSO project moving along. Next slide, please. Next slide, please. So we've got a proven DSO mineral resource. One of the photos there you can see standing on the outcrop. We've already got an existing village there, our 40-man camp, which will need to be expanded to 100 men. There is a logistic supply chain where we can move to develop this project. And last year, we actually went out and tendered all the major contracts. So we're looking at a contracting strategy to keep all our capital costs low for startup. And we've also trimmed those contractors down to a preferred contractors. So next slide, please. So these are all the contract tenders that we actually went out for. We've got our preferred contractors on standby. So we'll look to reprice next month to get all updated pricing to go into our financial model with a view to progress the development of this project. As you see in the attached plan, there's a location of our the layout of our mine and mine operations centre and crushing. So next slide, please, Tim. So the logistics front, where our mine site is, we have to construct a new haul road about 28 kilometres down to the Menzies Northwest Road, or alternatively is called the Menzies Sandstone Road. And then there's a 120k haul to our Untitled rail siding site, which is about 5 kilometres south of Menzies. That Untitled rail site is fully approved, ready for development also. So the intent will be to haul DSO to that rail siding and load onto rail, which will travel from Menzies down through Kalgoorlie down to the Port of Esperance, so a total rail haul of about 500 kilometres. Next slide, please, Tim. So, and we see Untitled rail siding as a very important infrastructure for this project. It's 5 kilometres south of Menzies, 2.6 kilometres long, encompasses the Goldfield Highway and the railway track. So we'll be looking to develop that to get our project up and running, which will, so we have 120 kilometres of road haul and about 500 kilometres of rail haul. So really keeps our haulage costs down, and that's already done in the Yilgarn as well for another iron ore operation that goes out through Esperance, those equivalent sort of distances, so it can be done. But I think also the future, when we develop our Mount Ida magnetite project, the intent would be to pump our concentrate to that rail siding, filter it, filtrate the water back to site for reuse. So we see this as a critical part of infrastructure within the region as well, and it's certainly important for us. Next slide, please, Tim. Now moving on to the Mount Ida magnetite project. A significant amount of work was done on this project in the past, $50 million worth of work. It's on a granted mining lease. We've got significant tenure for infrastructure location, and we've got all the all the water, nearby water in the prospective good quality water regions pegged, sewn up. So we've got all that locked up in the region. And more importantly, there is a lot more renewed interest in magnetite. Our neighbour, Legacy and Hawthorn, end of last year announced a joint venture earn-in with Hancock Atlas Iron, and they're about to commence pre-feasibility study on that project currently. So they're looking to mobilise drill rigs into our region. Next slide, please. So, it's a great opportunity for Juno to have this project in its portfolio. Having over $50 million spent on it, 100 kilometres of drilling. A lot of technical work has been done, but really to take this project forward is we're going to look at an alternate metallurgical flow sheet, more along the lines of what FMG are doing with Iron Bridge. I do quite like that flow sheet. It gets away from the conventional flow sheets like we see in magnetite projects already within Western Australia. It uses a lot less water up front, more dry processing up front, and more efficient comminution methods with high pressure grinding rolls. So essentially it is a lower capital cost intensity and lower operating cost intensity. And if you can compare those capital costs against the previous projects that have been done for the amount of tons getting produced, you can easily see the much more efficient in the capital cost intensity. So really to take this project forward is go out and secure our water supply, and that's by undertaking exploration on our current water licenses, but also doing some more metallurgical test work, drilling and pilot plant work to firm up an alternate flow sheet. And also we need to undertake further environmental surveys on this project to take it up to the expanded 2016 guidelines. So they've already had all their environmental surveys, but due to the changing conditions, they do need to be updated. So, but we will be focusing on getting our Mount Mason project up and running first, and then we'll look at starting to do work on our Mount Ida Magnetite project. Next slide, please. This was the conceptual plan that was done back in 2012 for the project. Obviously, we'd be looking at revising that somewhat, but probably not a lot of change in that. Next slide, please, Tim. So the high-grade magnetite, we see a lot of discounts getting applied to low-grade DSOs in the market these days. There's a lot of advantages to magnetite. For smelters, a lower environmental footprint, plus it's attracting a premium price above DSO products these days. Next slide, please. Within our region, we've seen more, in Western Australia, a lot more metallurgical activity. FMG, they're currently constructing their 22 million tonne per annum magnetite project up in the Pilbara. That's going to get commissioned in early next year. They've also announced early this year is they're doing a year feasibility study on Sinosteel's magnetite assets to acquire 50%, but also undertake 100% ownership of the Ecg infrastructure project. Mineral Resources have announced they're testing magnetite potential at Koolyanobbing. MacArthur Minerals who our neighbours have recently released a feasibility study on the Lake Joel project, and also Hancock Prospecting, who are now our neighbours, doing a pre-feasibility study on the Mount Bevan project. Next slide, please. So this shows a bit of a location where we're at. As I said, in the Yilgarn, quite clearly we are the largest magnetite project in the region and one of the most technically advanced. Legacy Hawthorn Hancock joint venture are our neighbours. Next slide, please. And this shows in comparison, just comparing the Yilgarn projects within the region. Next slide, please. So really, for an investment sense, in the market, our market cap, just in relation to our magnetite project, we are really undervalued compared to our neighbours and in the region. So for an investment proposition, the case is clearly there as we move this project forward. So that's been a really quick run through, a bit of a snapshot of where we're at, but finalising, we'll be, as I said, focusing on getting our Mount Mason DSO project up and running and targeting in the June quarter next year. Then once it's up and running, we'll look at doing all the other work to reconnect our Mount Ida Magnetite project. So thanks, Tim.
Thanks, Craig. A couple of questions. You've got POSCO on there as a shareholder. Are they a potential offtake partner for this?
They do have rights for 50% in offtake on the product. Yes, for sure. So,
yeah, good. It's a strategic shareholder there, and you spoke a lot about water. How do you obtain water rights, and from an environmental perspective, is that difficult to deal with?
No, it's not. You just apply, select the area where you think is most prospective for water, and you apply a water exploration license over it. So it's quite straightforward. Yeah. So
and plenty of water out there, I assume.
There is where on all our reviews and research on those areas, we dealt with a high-level hydrogeologist who did a lot of work in that region, and he recommended the areas that we peg to secure our water supply. And we did that back in 2011, 2012.
And you've obviously had a significant amount of money, 50 million spent on some of these projects. How do you prioritise moving forward?
Yeah, so all the geology, all the drilling's been done, the geotech's been done. So all the hydrogeology's been done, hydrology, all the technical work's been done. But as I said, what we need to do to take this project forward is to actually drill holes and do and make production bores to secure our water supply, and also to undertake the further metallurgical test work to firm up an alternate flow sheet, which is lower capital cost intense and lower operating cost intensity. So those are, so we get a lot of credit from all the work that's already been done, but there's still a fair bit of work to do to, obviously secure all the infrastructure requirements that we need to do, screw up our water and do all the metallurgical test work. But we're certainly in a great position at the status of where this project is at.
And just finally, Greg, just on a time frame, what's the timeline look like?
So for Mount Mason, we look to get in production in the June quarter next year. And I envisage will be another 2 years of work from there on the Mount Ida Magnetite project to take it through to a definitive feasibility study level. So there's really another 2 to 3 years work to be inputted into Mount Ida to take it to a DFS level.
Thanks, Craig. That's all we have time for. We'd love to follow up again later in the year. Good luck out there.
Yeah, great. Thanks, Tim.
Next up, we have eCargo, Asx Code Ecg. It's only small, market cap of around $7 million. We have with us Lawrence Lunn, who is the CEO. The company is an e-commerce and offline sales enabler that provides holistic solutions to brands from across the spectrum, from high-end fashion to consumer goods to beauty, healthcare, and other products. Thanks for your time, Lawrence. Over to you.
Thank you, Tim. Well, thank you everyone for listening in. It's my pleasure to be able to share a bit about eCargo on this webinar. So I guess we can go right in. Next slide, pass the disclaimer, please. Simply put, we are a growth accelerator. And what we mean by that is basically any brand or retailer that wants to trade in Asia, in particularly China and Southeast Asia, we support them. And we leverage it through basically 3 main service areas, right? Leveraging our distribution and trading capabilities across our 120 team member in China, Hong Kong, and Australia. We provide a wealth of end-to-end services, and then we also provide technologies that we enable that to really accelerate those sales in those markets that we trade in. Our company was founded in 2014, and we were listed at the end of 2014 in the ASX. And it was really on the back of one main theme, is the Asia markets will grow on the back of rising income, and rising income would generally have a higher demand on quality products. And brands that are in Australia or in other parts of the world will really need the support to get into these markets to operate, given that the complexity, the different cultures, languages, and more. So we can move to the next slide, please. So what are our services? If we look at really the 2 main services that we provide, one is what I call distribution and trading, and the other one is what I call e-commerce and digital services. Around digital distribution and trading, we basically split between two. One purely online, and the other ones that we will actually support brands to go into offline distribution into brick and mortar stores. Online distribution is really where a bulk of our revenue is generated from, as we trade both cross-border and on domestic e-commerce platforms. There's over 30 different platforms that we trade on, whether we help the brands set up their own flagship stores or they trade through the stores that we operate on. While distribution and trading for offline, we have about 4,000 point of sale locations that we help support brands to get in. And these include supermarkets, convenience stores, department stores, specialty boutique stores across China, Vietnam, and Cambodia. And the whole idea for distribution and trading is we work on margin, right? Brands have product, we acquire them, and we then trade into those markets. But trading is only one element of it. You also have the market activation, the marketing, the branding side of it. That's where our digital services come in, where we actually set up stores, we do provide marketing services, we provide content services, and those are on more project fees, retainer fees, and commissions that we generate. Next slide, please. So how does that look like? Since 2014 till up to now, we've been really fine-tuning our services and to really create one end-to-end value proposition that we can offer to our brand principals. On one end, it's really logistics and warehousing. That's really where we started our business, given that we were backed and we spun out of a larger organization called Cargo Services, which is a freight and logistics partner. So logistics and warehousing is one element that we provide, and that includes freight, overseas, local warehousing, and importation. We provide custom clearance services. Those are actually more complexity comes in because each country has different rules, different regulations, different tariffs, import duties, as well as labeling requirements. So we have a team that really supports all our brand principals on that. Our extensive distribution network, we have now over 120 distribution partners that we work with that generates over 4,000 point of sale locations across China, Vietnam, and Cambodia. These point of sale locations give us access to over 300 million people within Asia. So we actually sell products through. And these are just point of sales in brick and mortar. So we also have online channels that we sell through, which I mentioned 30 different platforms, as well as consumer to consumer stores, which is these small community stores that other people set up, and those are over 2,000. So we have different ways to help activate through our distribution network. E-commerce development. So we provide setup of stores, whether your own brand site platforms on Salesforce Commerce Cloud, Shopify, or even on set up your flagships on marketplaces. That's kind of we provide our brand principal with that service. Market activation, growth optimization. Really, you can't really sell anything unless you have marketing expertise. So we have a strong marketing team that sits across different countries that really helps our brands build up their branding, get their message out, even do trade marketing to really support the brand growth in those areas. Channel management service, we have a team that sits in China that provides customer service, operational work 24/7. The idea is really to support our brand's underlying customers to ensure that they are handled properly, the experience is well managed, and so that they can continue to grow nicely. And then lastly, all this comes down together is really generates a brand growth program. And the idea is really any brands that get into these markets, they want to grow relatively quickly. And we have a structured program across all our services to bring them and to help them grow in the markets, and particularly China. Now, the last 2 years has really helped us in the sense that, given COVID, online have really shifted in terms of customer behavior. So in terms of online generation, as well as how the need for our services have become very highly sought after. Next slide. So what does that really mean? How do we really help our brand principals? I summarize this with basically three things. When we look at the supply chain, one area is supply chain efficiency. Through our services, we're able to really support them on better cost management around how to move product from A to B. So whether it's from logistics, we help them with better costs, better structuring, better management in terms of shipping, in terms of how to consolidate products into a container. We provide those cost savings to the brand principals we work with, as well as fulfillment and inventory management, how to manage sell-through, how to look at where the product should be based in order to get the greatest sales that we generate using the solutions that we provide. Distribution efficiency, because of all the distribution channels and networks that we have, we really accelerate a brand's position when they get into the markets that they want to trade in. So for example, in China, any brand can technically go in and try to sell it themselves, but working through us, we can immediately get them into offline retail stores. We can immediately get them onto online platforms without such a high level of investment that's required. We also drive really high sell-through rates across the markets that we trade in. So that really helps the distribution efficiency and generate that revenue for the brand principals that are working with us. The third area is what I call capital efficiency. Ultimately, every single company we work with, besides working on supply chain and distribution, this always comes down as cash flow. How do they actually generate better cash flow efficiency within their business? And I guess the beauty of working in an end-to-end business manner is we actually have a full visibility on the sales, on the product movement, the trading aspect of our underlying customers that generate quite enough data that can provide to financial intermediaries and fintech as alternative credit data for them to actually have better capital access. So I'll touch on that a little bit on how we actually do that afterwards. Next slide, please. So how do we came about? Our business, when we first founded in 2014, was really focused purely on e-commerce. But as the market evolved, we started making acquisitions into market that really generated a full service value. So in 2018, we acquired Metcash's export business, and that immediately overnight gave us all these offline distribution channels across Asia, and that gave us the contracts with distributors as well as supermarket chains that we can actually sell through. What we realized was that purely selling on online worked, but it wasn't enough in terms of getting the product into the consumer hands in a greater manner. So we needed the offline distribution side as well. So hence when we make that transition, we make the acquisition, our business starts growing at a more rapid rate. Where we're trying to move now is we have the distribution channels, we have all the pieces together. How do we really truly link all the data and the technology together to really support our customers with better decisioning, so that we can grow and help them grow even quicker in terms of their sales that they sell into those markets. Now we work in really four main categories in consumer goods. One is baby and mom products. The other is health and wellness. Third is our personal and beauty care. And then last one is premium food and beverages. These are really the four main categories we focus on, and those are brands that we support as well through our journey. Next slide, please. So what have we achieved so far? Last year, if I can highlight some key figures, we generated our first net profit after tax for the group since we listed, of Hong Kong dollars 900,000 Australian. Sorry, 150,000 Australian. EBITDA, we grew 21% compared to 2020 to about 9.2 million Hong Kong dollars, which comes down to be 1.5 million Australian. We launched new tech platforms. The idea was that we don't purely just want to be a service partner, we also want to own our own platforms to support. So we launched one, it's called JJX, which is a B2B cross-border trading platform, leveraging any brands that are in Australia that wants to get access to our distribution network and just list their product on, and then they can already trade while we provide the services in between. We also launched a cross-border fine wine platform. It's a marketplace. And we launched that in October last year, and since then we've grown now to over 15,000 SKUs, selling fine wine into the Chinese consumer via cross-border e-commerce. We're also able to reach profitability across all our business units, including our trading and distribution business, primarily due to higher margin products that we focus on, as well as better cost management. We launched into new product categories. I list here two new brands that we took on late last year, which we started the business this year. One is called Ella's Kitchen, which is in the baby and mom category. The other one's Fentimans, is a premium food and beverage a brand that now we trade in Asia for them exclusively. we launched in terms of, we've really fine-tuned our value proposition so we can fully integrate our customers into our value chain within eCargo. Next slide. What I want to highlight here is really two main key indicators. One is our gross profit. We generated our highest gross profit in company history since we listed, about 88.6 million Hong Kong dollars. That comes down to be about 16 million Australian. As well as our inventory turnover, because we are a trading and distribution business in nature. So generally, our inventory turnover is a very important measure. We've been able to really lower that since 2019, which was 97 days to 35 days, just because now we have better focus on products, we have better inventory control, and we have better sell-through on this. Next. So where are we going for the rest of this year and onwards? Really two main strategies that eCargo has been focusing on. One is supply chain digitalization, how to really work on the supply chain and digitalizing it, because cross-border trade has always been very manual and very troublesome. And we use our different experience and our technologies to support that. Streamline and accelerate. We will continue our partnerships with high-value brands and expand into new regions in Southeast Asia. So that's kind of where we're repeating our model that we've done well in China into new markets. Next slide, please. So these are the three platforms in terms of digitalization that we've been supporting. One is JJX, which I mentioned, a cross-border trade platform. We've generated over about 35 million in sales Australian last year since we launched the platform. PJF Wines, we've now grown as a cross-border wine platform with 15,000 SKUs. Average order value is about 2,000 RMB, which is about 450 Australian dollars per an order that's generated. And then our data-driven funding platform is called Flow, that we're now partnering with banks and fintechs to provide data that we're able to generate to support our brand principles with funding needs. I guess it'll be the last slide. And the last slide here is simply where we focus on in terms of our streamline and accelerate. There's really three areas. One is our category specialists. I mentioned the categories that we'll focus on, market expansion into Southeast Asia, as well as brand equity. We're going to go upstream now that we have all the pieces together, and we'll be starting to invest into brands and own the brand piece as well, so that we can actually facilitate more value for our group and eCargo. And then the last slide will just the brands that we work with, including Blackmores, Fonterra, group in Australia. You'll see some brands in the UK, and then some of the channels and partners that we work with on the right side. So Tim, I'll stop here. Maybe we can just go into questions.
Yeah, thanks, Lawrence. Quite a few questions. Did you actually say $16 million net profit in 2021 via market cap of around 8 million? Is that correct?
Sorry, Tim. Yeah, I missed the first part. I think I got an internet.
Sorry, just on the conversion of the Hong Kong dollar profit in 2021. Did you say that was around 16 million Australian dollars? I'm just looking at your market cap around 7 or 8.
Yeah, no. So our gross profit was 16 million. Our EBITDA was 1.5 million Australian, and our net profit was about 150,000 Australian.
Right, and is that because you're taking the margin on the sales? Is that right?
Correct. We take we earn a margin on the products that we trade on. So typically our margins ranges between 40 to 50%.
And so where does so we've seen a lot of the big retailers holding inventory, like Target, for example. Has had some profit downgrades in the US because they're holding a lot of inventory they've bought ahead of the supply chain. Who holds the inventory risk here in regards to this model?
Yeah, so our business is a little unique because we work with a lot of sub-distributors, and we act as the exclusive distributor. So generally, the inventory risk is actually passed to our sub-distributors. So generally, we don't carry much stock. We actually trade all B2B deals. And then we just basically manage the logistics and the credit management between our sub-distributors and us.
So when you talk a sub-distributor, that's the distributor of the brand before they come through your platforms?
Correct. It would include retailers, right? Some of the ones that live here on my right side are sub-distributors. We also have regional distributors, basically they will manage a particular region within a country, and they have to acquire the products from us. We will manage the brand marketing, we will manage the distribution management, we will manage the logistics to ensure that they get the product on hand so that they can trade.
Right. And so what's the kind of, a lot of supply chain issues? What are the largest kind of bottlenecks for brands in terms of their expansion into Asia?
Yeah, I think this is one of the reasons why brands and retailers like to work with partners like us, because when we look at cross-border trade, one is, as you mentioned, logistics and supply chain. Given the whole disruptions globally now, they really need a partner that can move product. And where one of our advantages is because we are one of our largest shareholder is a logistics and freight company that's one of the largest privately held one globally. We're able to have access to a lot of freight bookings, scheduling in a more favorable terms, as well as cost on that front, so that we're able to really pass that towards our brand principles. And then as well as when we're looking at for brands that want to get into a country like China, they're talking about language barriers, currency management between renminbi and Australian dollars, and import rules, labeling rules. All those becomes complexities. So hence where we will help them with help them alleviate those problems as a solution provider.
And do you always have to work with that sub-distributor? Have you got examples where you work directly with a brand?
Yeah, so so on one end, we work directly with the brands, right? Because we are their partner, while the sub-distributors are the ones that we would distribute product on. So we bridge the gap between the brand and our sub-distributors. Now, there are places where we will go direct to consumer, that we sell on behalf of the brand to the consumer, is where we mostly focus online. So we would generally help them set up their own flagship store online, and then we would trade direct to consumer that way, not leveraging a sub-distribution for that management side. So those are different ways that we operate. So for example, if I can take a brand like Ella's Kitchen, we operate all their online channels direct, so we sell direct to consumer.
Oops, looks like we've got an internet issue.
They're actually the top selling baby category product on a platform like Tmall Global.
We just had a bit of an internet issue. Just last question, Lawrence. What sort of opportunities are you prioritizing for the rest of 2022 and moving forward?
Yeah, so one of our main priorities right now is actually looking at brands that we can actually acquire. We've always been a service provider, and we have all the pieces together that we now know how to get a brand up to their sales and generate that value really quickly. We also want to be a brand owner as well. So that's where we're looking at different types of investments into different brands that are within a good size that we can take into our ecosystem so that we can grow even more rapid.
Thanks, Lawrence. That's all we have time for. It's been a great episode of Hidden Gems. Thank you all for your time. Enjoy your long weekend. We'll see you again next week.